Fed Chairman Powell has said that the recent turmoil in the banking sector is likely to cause bank lending to slow, and that slower bank lending, should it occur, would weigh on economic growth, hiring, and inflation, thereby reducing the need for the Fed to increase the federal funds rate as much as it otherwise would have. For this reason, Powell appears inclined to leave the federal funds rate unchanged at the next FOMC meeting ending June 14th. Obviously, what the Fed does with interest rates will have a major impact on the stock market and other asset prices. Therefore, in this video, MacroWatch will look at recent trends in bank lending to see if there is evidence that lending has begun to slow. It will also discuss the Fed's H8 release, where weekly data on bank lending is published, and show how this release can be accessed by the public so that subscribers can keep an eye on this data during the weeks and months ahead. Every Friday, the Fed publishes its H8 release, which details the assets and liabilities of U.S. commercial banks. If you Google assets and liabilities of commercial banks in the United States, this page will pop up. There, click on the most recent date. Then scroll down and you'll find 11 tables with details about U.S. banks. We're going to look at Table 2. Here's a screenshot of the top part of that table. Table 2 contains a breakdown of the bank's assets and liabilities. Since I can't show you a screenshot of the entire table, here's a summary of the commercial bank's assets. Their total assets add up to $22.9 trillion. That's comprised of $17.3 trillion of bank credit, less allowances, cash assets of $3.3 trillion, total federal funds sold and reverse repos $640 billion, loans to commercial banks $9 billion, and other assets, including trading assets, $1.8 trillion, for a total of $22.9 trillion. We're most interested in bank credit, $17.3 trillion. Because we want to know if it's slowing down. But while we're here, notice cash of $3.3 trillion. As bank reserves, cash earns 5.15% interest from the Fed now.